All right, so that's the big decision coming in from the RBI governor. Indeed, yes, of course, it's been a bit of a surprise, not just on a 50 basis point of cut that the RBI has just announced, but 100 basis points of cut in the CRR is indeed big, and that will give some headroom for the banking space, given the liquidity crunch that they have been dealing with. The RBI has taken multiple steps on that particular front, but going ahead, another push to the liquidity into the system that is coming in by the RBI. 100 basis point is indeed big, and on the time of announcement itself, we have seen a big spike and a recovery on the banking index as well, because if you will see, the banking index has indeed boomed and it's over that 56,000 mark as well, holding on to the gains of 230 points right now, while Nifty 50 is also having a good stance and a good move on the overall markets. And yes, indeed, a lot of these sectors, from the auto to real estate pack, they are cheering the kind of decision that the RBI governor has taken. But we have a whole host of experts to try and dissect for us that what you should make of the policy announcement. Was it on the expected lines? And we have Dr. Ashima Goel, ex-member of MPC, RBI Emeritus Professor at IGIDR, also with us. Hi Ashima ma'am, great to be speaking with you yet again. So ma'am, help us understand that how do you see the policy results? Is it something that even you were expecting, or is it a surprise coming in?
Yes, last time I had asked for, I had expected a 50 BPS cut in the last policy, and they have done it in this one. So I think what the governor said, front loading, is the key word to understand this policy. They have front loaded monetary policy space, and they've switched to a neutral stance from here on. So they're signaling that there's not much space left to cut, but they want markets to pass through for this to affect growth in a positive way, given that currently inflation is really low and is expected to be below their target for the next year. Their inflation forecast has fallen to 3.7%. So with the excess liquidity in the system, so that actual short rates are nearer the lower end of the lag. So that means that the real repo now is around 1%, right? It's below 2% at least, which is very positive, because historically we have seen whenever the real repo rate rises above 2%, that tends to dampen activity. So I think this is a positive for the economy. They've used the space they have, taken a front-loaded cut and a liquidity injection to support growth. But I think for the banks, because bank economists have been asking for a 50 BPS cut, which is a big change from their stance in April, because they were worried about liquidity being tight and not being able to pass through, and deposit growth being less than credit growth. So we've seen a big change in these 2 months as liquidity became in excess. The growth rate of credit has converged to deposits, despite cuts in some beginning in cuts in deposit rates. And now banks are finding it difficult to deploy all the liquidity in credit. And they also think that a cut in rates will help them increase loans, remunerative loans in the system. This is also positive for MSMEs, who are very sensitive to the interest rate level. It will reduce NPAs, some stress in the microfinance sector.
All right, this policy seems to be double bonanza in whatever was expected, whatever was anticipated, and economists were penciling in. You expected 25 basis point cut, 50 basis point has come. There was an ask for 50 basis point CRR cut. It has come in at 100 basis point. But there is a surprise too, that Reserve Bank of India has now said that shift of stance has happened. Mr. Dinesh Kumar Khara, I would want to come to you for a reaction. 100 basis point cut, will it fuel credit growth?
Well, the CRR reduction of 100 basis point will certainly help in terms of when it comes cost of funds. It will certainly improve the cost of funds. What will happen is that when this transmission really happens, when So actually speaking, there would have been a pressure on the NIM. So I think with this reduction in the CRR by another 100 basis point, it will actually help the banks in protecting their NIM also, because the cost of credit will come down. So I think it's a very welcome suggestion. I would say that it was overdue for quite some time, but now having done it, it will also address the liquidity related concerns which were actually addressed by RBI over all these, for last about 6 months plus, through various repo mechanisms. So I think it will actually ensure that there is a system as a whole should be in a position to support itself when it comes to the liquidity. So I think it's a very welcome step. And apart from that, the 50 basis point reduction is also very encouraging. Those stance is of course one concern, but I think it's on balance, it's a very welcome policy which has been announced by RBI governor.
All right, we also have with us Mr. R. Gandhi and Nilesh Shah joining in the panel. Mr. Gandhi, I want to come to you first. The change of stance is something which is left everybody in surprise, from accommodative to neutral. What do you think is the reason for that, and what will it deliver as far as RBI's projections are concerned?
That is quite a surprise to the market, of course, but the governor has given the rationale why MPC has decided to do so. First point that we have to appreciate is that Reserve Bank has front-loaded quite a large cut in repo rate, and also larger cut in the CRR. That is, the governor really mentioned that he is front-loading whatever possible monetary policy and liquidity action that Reserve Bank can take. And he also cautioned that this is the thing that we can do. Hereafter, heavyweight will have to be taken by implication by fiscal policy. That's what is whatever monetary policy could do, we have done well in advance, anticipating that we have to support the growth. Since that inflation is quite under control. So we have done quite a lot on what is possible by the Reserve Bank. Hereafter, it has to be by the economy, and more specifically, the fiscal also. So that is why he has shifted the stance to, or MPC has shifted the stance to neutral, because nothing more we can do. That's the implication there. And if at all, there can be negative depending upon the circumstances, if Reserve Bank had to take opposite action in terms of increasing the rate or anything, if inflation is rearing its head again, then to be in readiness, they have gone to neutral stance. That's my reading.
All right, Mr. Nilesh, I want to come to you for a reaction. In cricket parlance, he has hit 2 shots, which is more than the run rate which was required. You talk about CRR, you talk about repo rate cut, but he has also sent a googly in terms of change of stance. How should market interpret it?
Well, after hitting 2 sixes, when the run rate is well under control, it is prudent to play the next ball cautiously rather than going for a third 6. That's exactly what Mr. Gandhi explained. RBI has front-loaded repo rate cut and liquidity measure to support growth. Now it is time to be focusing on other parts of the economy, other parts of the banking, rather than continue to give hope to the market that more rate cuts are coming.
All right. We want to take a reaction from Mr. Khara now on the announcement which has been made. No further liquidity announcement, but CRR cut has happened. In terms of banks, treasury, do you think this will be a big boon from Reserve Bank of India this time?
Oh, certainly, because the CRR was essentially the preemption of the money. So now that money is available for lending, and I'm sure with the kind of focus which is there on the growth, which is actually the intent in this policy also, which is very clearly articulated. So I think it will certainly help the banks to, and also for the treasuries also, that they will be in a better position to really improve their overall earning on the portfolio.
All right, Mr. Gandhi, I want to understand from you this dynamics. In one policy, the stance was shifted, another policy gone back to the previous stance. Do you think it will give more flexibility to Reserve Bank of India in future rate of action with the kind of trade tensions and the evolving situations which are there?
That's correct. That exactly is intention, because right now, having done or having exhausted what all possible measures the Reserve Bank can take in terms of rate cut and also CRR cut, they hereafter they have to play safe. They have to clearly look at the evolving situation in terms of trajectory, even though the forecast about inflation is quite benign. But obviously, central banks would always like to be cautious. That is why they have shifted their stance to neutral. That doesn't mean that they will hike the rate or anything. No, they are, as you mentioned, they are keeping themselves in readiness to move either way.
And Goel ma'am, I want to come to you. And ma'am, we have seen some tones of underlying concerns coming in from the governor's speech, while all else seemed positive. There's one statement that I want to ask you about, which is at the very beginning of the speech. He said MPC is left with limited space to support growth. Now, while all seems in control, the inflation is back to the government's target. Do you think he has already given us an indication of what we could expect from the next policy meeting, which could be no action at all or no change in rates? Because like Mr. Nilesha also mentioned, it's time to play slow now. On the flip side, for quarter 4 of this year, this financial, he's expected the inflation to inch back up to 4.4%. So what could the next policy look like?
Yes, I think again, as I said, the key word is front loading. They have front loaded the space they had to cut in order to stimulate pass-through and the positive effect on growth. So a neutral stance allows them to move in any direction. They can pause, they can cut, or they can raise. So therefore, the next policy will be data-based. If there is a sign that that inflation is persistently going to be below 4%, they may have space for another cut. If, as the current forecast in Q4, it will be back to a little above 4, then they're likely to pause. So it will be data-based. It will depend on how the inflation and growth numbers pan out and which needs to be supported more. Right?
Appreciate that view, ma'am. We also have Abhik Barua, who's joining us on the show. He's an independent economist. And Abhik, hi, thanks so much for joining us on the show. Now, what I want to talk to you about is the dual thrust that has come from the RBI on the reduction in the repo as well as the CRR. Now, would you believe the RBI is trying to send a dual signal over here, because this also affects the price as well as the quantum of money supply in the economy? Which one of these parameters do you believe will start affecting the economy sooner, and where do you believe in terms of macros we're headed ahead?
Well, I think this was a very clever tactical move to take advantage of the current low inflation scenario and front load the rate cut, which I incidentally had argued for in different forums. And I think Ashima explained this very well, that going forward, the element of data dependence creeps in. And I think we tend to forget the fact that the global inflation situation is still very fluid, and it could just as well spill over to India. And, pre-committing effectively through an accommodative stance to another rate cut, at least that is how the market would construe it, would perhaps not have been sensible. And I think the RBI's playbook has very legitimately shifted to liquidity management, and I think they are kind of countering the low credit offtake, the lack of transmission, etc., through that as well as the repo rate cuts. But I think liquidity management and liquidity support has got much more importance and emphasis in the current regime, and I mean Mr. Malhotra, Governor Malhotra's regime, than in the past. And I think it's a very sensible playbook, and I think we just think back on how he started his speech, where he talked about the myriad global uncertainties. At this stage, the bias in sort of reading or interpreting these uncertainties is that it'll be deflationary for the global economy. It could just as well turn out to be inflationary, in which case having a neutral stance certainly helps.
All right, but Mr. Shah, I wanted to have your take on the markets as well, because this particular move by the RBI, the markets are rejoicing the fact, because Nifty Bank, look at the move, it's more than 600 points of jump, getting into that all-time high zone. Along with that Nifty 50, it's a double century, once again near to that 25,000 mark. Yes, it's been a bit of a surprise, but Mr. Shah, which sector can actually surprise on the upside? Because this news flow is indeed positive for banks, NBFC, real estate, and the list is long.
So it's not a bit of a surprise. It's a big surprise. After nudges in the initial power play, RBI has changed gears by front-loading pro-growth measures. Both the bond market and the equity market has been positively surprised. The yields had gone down from 620 to 612 based on 50 basis point rate cut. It bounced back to 620 when they realized that stance has changed to neutral. And again, it started coming down when the CRR cut announcement came. Same thing happened in the banking sector and broad market. It came down when they heard repo rate was cut by 50 basis point, as it would have impacted banks' NIM margin. Bounced back once they realized there is CRR cut happening. Overall, I think both debt and equity market will be positively surprised by this front loading of growth measures. And now actually I have a worry. I hope President Trump doesn't borrow RBI governor to manage US Fed.
All right, Mr. Khara, help us with your take on the banking space, because this too has been a big booster. So which particular move you believe can be a big booster, or rather a better booster for the banking space? Is that a CRR cut that the banks will be working, or is that the overall decline in the repo rate that the RBI has announced? And what does it really mean for the banking space?
Actually speaking, if at all you look at the structure of interest rate in the banking system, wherever it's linked to the external benchmark, then the transmission happens immediately. But when it comes to repricing of the liabilities, it takes some time. Normally there's a lag of about 6 months to a year. So I think repo rate reduction would have led to that kind of a compression on the NIM. But nevertheless, the reduction in the CRR is something which will actually reduce the cost of funds for the banks overall. So that is something which will actually turn out to be very positive, because whatever impact would have come in for the repo rate reduction, that is actually getting compensated, or maybe more than compensated, through the CRR reduction. So I think, to my mind, this is the CRR reduction and also availability of ample liquidity in the system is actually helping the banking system. And it will go a long way in terms of supporting the banks.
All right, I want to come to you, Ashima, for a question. You have been in MPC earlier, so you would understand this better. This change of stance which has happened from policy to policy, last time when you were in MPC, there was a lot of question about the stance of Reserve Bank of India. Do you think it has been adequately answered now by Governor? And second question on inflation growth dynamics. While there is a revision in inflation forecast, growth target has been kept intact for FY26. How should one read it?
Yes, I think the governor has clarified in one of his earlier speeches that the stance now is with respect to the repo rate. So a neutral allows flexibility in any direction. in the earlier MPC with Governor Shaktikant Das, it was linked to, because it was the post-COVID period and large excess liquidity had been created. So there is one more, couple of other issues I want to flag about this front loading, and it is that we should recognize that with inflation targeting, our volatility in inflation is going down. The CPI, the range within which it moves is much lower than it was earlier. It is not going as high as 6 and 8%. And therefore, the degree of change required in the repo rate is also lower. So markets that were expecting a repo rate, a terminal rate at 5 and even negative real rates should realize that you don't need that kind of large repo rate movement. So what the governor has communicated is that we have used the space in a front-loaded manner, and now it depends on how inflation and growth pans out. Yeah, he's kept that flexibility. And that comes to your question about the change in the growth forecast staying the same. So as has been remarked, there are some stresses in the system, some negatives from this volatility we are seeing in the global regime. And there are positives on inflation, softening in oil prices, good monsoon. So the inflation rate has been brought down. But, this is another nice thing about this policy, because in the past, what the RBI is always afraid that inflation will come up again. In 2015, when oil prices fell, they did not cut the repo rate because they were afraid oil prices would rise again. So here their forecast is 3.7 for the year, although it's rising to 4.4 in Q4. But they have taken the cut now so that the real repo rate does not rise with the current fall in inflation. And they have given themselves room to respond as inflation changes. It might be that inflation continues to fall or is anchored around 4%. Some research I've done suggests that firms are starting to internalize that 4% benchmark, and they are not passing on commodity price inflation as much as they used to earlier. So if indeed our inflation is getting anchored around 4%, we'll see much fewer changes in the repo rate, much smaller range of changes in future. And I think this change of stance points towards that the RBI is not overreacting, is not cutting too much, or the market should not assume that there will be too many cuts, because that leads to, that increases volatility in the.
All right, thank you so much, Ashima Goel, for joining at this hour. I want to come to you, Mr. R. Gandhi, for the question on growth front. While there has been no revision on the growth guidance, Governor has mentioned that they have done enough in this policy as far as the rate cut is concerned. 50 basis point has been announced. I want to understand from you, now the options from Reserve Bank of India are limited to push growth?
Yes, that's a first implication we have to read, that whatever possible in terms of cutting the rates and increasing the liquidity, the Reserve Bank has taken action. Because any more cuts can disturb the household savings. Because household savings, now the interest rate will be still further down, because totally in this last three policy announcement itself together, it is 100 basis point cut. So it can affect negatively the household savings. So that is why they are cautioning that by any more cuts, if it is done, then it is going to be difficult for savings to be encouraged. So that is one thing Reserve Bank obviously has kept in mind, to indicate that don't expect some more cuts automatically. That all depends upon evolving situation. That is number one. Number two is that in the fourth quarter, the inflation forecast is 4.4. And if the growth gains momentum, then it can lead to further increase in inflation. So at that time, obviously, Reserve Bank will have to ready itself for taking action on the other side. So that is why the neutral stance. That way. So a growth in any case, growth has always not the primary weapon, cannot be monetary policy. for growth, it has to be beyond monetary policy. So that's why indirectly indicating that whatever we can do from monetary policy angle or liquidity angle, we have already done it. Hereafter, it has to be shouldered by other forces. So both private investment, they will have to get higher confidence and encouragement because of these rate cuts. So that will increase the growth momentum, and fiscal policy also, if further impetus is coming or public investment continues to be robust, then the growth trajectory could be more. So that is the second. Another caution which he has mentioned is relating to international situation, that even though today oil prices are very benign, that is on the positive side, but the geopolitical situation can disturb the situation and the tariff related impact. So these things have been definitely been kept in mind. So that's why you are right in the sense that for supporting growth, now the forces which will have to be encouraged is beyond the reserve.
Okay, appreciate that view, Mr. Gandhi. Let's just talk about the recovery that we've seen in the Nifty flashing on the bottom of your screen, a 1% uptick coming in from the day's low. Nifty Bank also at all-time high, looking very good. We also now have Mr. Sriram Ramanathan of HSBC Mutual Fund joining us on the show. But Mr. Ramanathan, before I come to you, I want to take a question with Mr. Nilesh Shah. And sir, help us understand the impact that you see of this surge in liquidity that will now eventually take place, the impact of that on the bond market. Do you believe the bond yield curve would flatten out? Because we did see a little bit of a spike coming in around 10-15 or so when the announcement was made about the surge in liquidity. Where do you see the bond market headed from here?
So the bond market's immediate reaction will be to do a parallel shift down. The short, medium, long all will come down to reflect 50 basis point rate cut adjustment. Then the short end may come further down because of the liquidity measures. From having probably adequate liquidity, or maybe if I can begin, there was a time when there was excessive liquidity of more than 10 lakh crore in banking system. Then it became adequate liquidity. Then it became deficient liquidity. Then it again became adequate liquidity. And now we are probably at the stage between RBI, OMO, the dollar swap, and the RBI dividend and CRR cut. About 12 lakh crore of liquidity has been imparted into the system. Clearly, when liquidity improves, the short end comes further down. The spread between 10 and 30-year is 60 basis point yesterday evening. I'm sure that is likely to narrow further. So we will see first parallel move down on yield curve, then short yield curve coming further down, and eventually long end of the curve also coming down a little bit. The one more factor which bond market will be looking forward, RBI's open market operation has been up to 14-year maturity. In the second half, can they go and do OMO in 30-year maturity? With this kind of liquidity given, unlikely that there will be a need for OMO. So we will see impact across the yield curve at different point of time.
All right, coming to you, Mr. Khara, I want to understand from you, banks have already reduced rates on deposits. We have seen that front loading has already happened with some banks. How do you assess the situation now? How will banking system deal with this kind of CRR cut and also reduction in repo rate? Do you think there is a scope for further reduction now?
Yeah, I think we will get to see some reduction in the deposit rates, but I would like to also mention that the CRR reduction is somewhere slated from September onwards. So I think, which also means that from now, June till September, about 3 months. So when it comes to transmission of the repo rate reduction, normally, as I mentioned, that it takes about 6 months to a year. So at least, it will actually balance it out. I think what I expect is that the deposit rates will come down. But again, in the past, what we have also seen is that the deposit rate, particularly if at all we look at the quality of the deposits, There have been an increase in the deposit rates in the past to ensure that there is a stable deposit available. So I think we'll have to look at different basket. Maybe I think that the term deposit or maybe the high cost deposit will certainly see the reduction immediately. That is something which will happen. But term deposit will probably, it will get spaced out. And that's how it will really show up in the bank deposits.
All right, thank you so much, Mr. Khara, for joining at this hour. Now I want to come to you, Mr. Ramanathan, for a comment. You have seen the projections of Reserve Bank of India at 6.5%. Do you think there is a scope of a positive surprise in FY26? We have already seen in FY25. Mr. Ramanathan?
No, I think broadly, while earlier there were some risks of maybe a little bit of downside to that 6.5%, I think the measures taken by the RBI are one very important part of the instruments used to make sure that we are close to that 6.5. So I think the chances of disappointment on that have reduced. Now for 6.5% to really go towards, let's say, 6.7 or 7%, I think we would need, we are really at mercy of what happens globally, the tariff part settling down, and whether India can really take some advantage in this whole realigning of global logistics supply chains and all that, and can we get some story going at our end? I think that's the real story for us to propel from where we are to 6.5 to 7% plus. But I think importantly, the RBI has ensured that downside risks to that 6.5% are now reduced meaningfully. And I think we think 6.5 is probably our base case for growth for next year.
Get your sense on inflation going ahead. Mr. Ramanathan, we'll come to you. The speech has mentioned that while you have food inflation and core inflation, both are softening. Commodity prices still continue to be at elevated levels. At least that is what we're hearing from Indian consumption players as well. Give us a sense of how much room does this give the RBI to adjust their liquidity indicators going ahead and their liquidity tools, given that on one hand they have front-loaded already on their scheme of things and the easing policy. But overall, how much room does this really leave, because this overhang is quite significant?
Sure. The question is to me, right? So basically, I think in this policy, what the markets were hoping will happen over the next, I think, 6 months between now and December has all happened in a day. So I think the expectation was obviously 25 basis points now, maybe a pause, and then another 25 maybe, a stance change, and of course liquidity, which would be required in the second half of the year. I think all of it, they have really front-loaded and used it as a sledgehammer incentive to the banking system to ensure transmission. I think that's the single biggest message. They want transmission to happen at the earliest. They are not willing to wait for 3-4 quarters lag. And I think to that extent, in terms of, I think it's more about now watching how these measures seep into the banking system. At what pace the deposit rates come off, which like we heard earlier, are likely to come off fairly sharply. Lending rates need to get transmitted. And that's really the real benefit to the ultimate borrower. So that's broadly our take. I think in terms of further measures, they've basically kept it data dependent, which means that we are really going to be dependent on what's happening with the US primarily. If the chances of US recession were to increase meaningfully over the next 3-4 months, and let's say the Fed really steps in a much bigger way than currently anticipated, yes, that is a scenario where we could see more action from the RBI. But on the other hand, if the US is as per expectations, which is about 2 rate cuts by December of this year, I think the RBI is going to has done whatever it can do. And now it's really nudging the banks to take action. I think the focus really shifts to the banking system now.
So focus shifts to the banking system. Mr. Barua, I want to come to you for a comment as far as the transmission of these rates are concerned. We have seen that banks have already cut rates in the past. Do you think this transmission will happen in next 3 to 4 months, or you think it is going to take longer? And second question is on the growth forecast. While 6.5% has been kept intact by Reserve Bank of India Governor, do you think that in the quarters to come now government will have to take some action?
Certainly, I mean, I think Mr. Gandhi emphasized this, that it is a combination of monetary policy and other policies, particularly, fiscal policy, as well as the sort of policy environment which activates things like the animal spirits of private investors and so forth. Monetary policy has done its bit. There could be an upside to this growth rate, even coming from domestic factors. If this could help, for instance, consumer leverage. The other thing that I wanted to mention, since we're talking about transmission and so forth, that yes, the RBI has kind of set the scene for greater transmission, but we also potentially or possibly have a new liquidity framework coming in that will kind of, I think, will be also very supportive of transmission. So a combination of a considerable amount of liquidity in the system, combined with the bank's specific needs on the liquidity side. Various things have been talked about, for instance, moving away from the WACR as the target rate to maybe the TREPS market, maybe widening the corridor, etc. These are very much on the table. They haven't been announced today. So in combination, I think a lot can happen. But I think there is a sort of overhang of the global situation. To the situation that Sriram just mentioned, I would also add what happens if there is stagflation in the global economy. How will emerging market central banks react? So it's kind of up in the air a little bit in terms of what the RBI can do, anticipating sort of the known unknowns, if you like. This was perhaps the optimal mix, but it's going to be data dependent, and let's not get fixated on a GDP growth number of 6.5%. It could be a little more, it could be a little less, and I think monetary policy will calibrate itself to kind of address deviations from this median path of 6.5%.
All right, Mr. Barua and Ramanathan, thank you so much for joining at this hour. So, front loading is the key word which is coming in from Reserve Bank of India headquarters. Whether you talk about CRR cut, whether you talk about repo rate, Governor has given double of what was required, hitting 2 sixes in a row, but also being cautious in terms of the stance, and the stance is now shifted to neutral so that whatever geopolitical situation arise, Reserve Bank of India is prepared to handle the same. Over to you.
Well, Ankur, absolutely. It feels like 2 sixes and right out of the park, not only for the economy, but also for our markets today, because we are out of that range that we were trading in and now very close to the 25,000 mark on the Nifty 50. It's been a 0.9% uptick, so almost a 1% gain on the Nifty ever since the policy has been announced. You can see that spike coming in on the graph post 10 a.m. It's the likes of Bajaj Finance, Shriram Finance, JSW Steel, Axis Bank, Maruti Suzuki, Kotak Bank, Bajaj Finserv. All of these stocks have been leading gains. Of course, the banking and financial pack in focus on the back of this rate cut of 50 bips coming in. Sensex 2 in tandem, 0.8% higher. India VIX a further cool off scene, looking positive for our market, 14.8 thereabouts, so comfortably below 15. Nifty Bank is the one to talk about, outperforming the market, and how a 1.5% uptick almost coming in on Nifty Bank, led from the front by IDFC First Bank. You have Axis, Kotak Bank, HDFC, AU Small Finance, IndusInd Bank, PNB. All of them are doing very well. And Nifty Realty, of course, if you talk about that, it's a lot of these home loan financiers are also going to stand to benefit, along with real estate developers, a 3% uptick on Nifty Realty. But with that, we'll wrap it up on this coverage of the policy as well as our edition of First Trades. From Shrishti, me and the team that put this show together, thanks so much for tuning in.
If you like this video, then like, share and subscribe to ET Now.